Hi friends, very good evening. Hope you guys are studying well and hope the revision lectures are helping you. Chalo, the agenda for our class today is a very important head of income. The first head of income in sequence, salaries. CA intermediate, something very important. It will definitely be part of your question paper. That has been the past trend of the institute question papers, except for the last attempt where once it was not asked in the paper, but every attempt prior to that, salaries is a short question. This chapter is a lengthy chapter. If a student views this chapter, understands this chapter, keeping in mind the thought that this is a formula based chapter, then it will become very easy for a student to approach the chapter to solve questions. There are many formulas in the chapter. The reason being, as an employee, when you receive salary income, it is not just one fixed amount that is given to you as salary. That fixed amount is split into various small amounts, and salary is paid to you in different ways. And every type of salary that is paid, there is a provision created in Income Tax Act, either for giving an exemption or for making it taxable. And so from a academic perspective, a student has to remember many things. So try and convert this chapter in your mind as formulas. The moment you are able to remember the formula, of course, formula remembrance will be accompanied by understanding the concept, knowing when to apply the formula. So moment you convert this chapter in your mind as a formula based chapter, solving sums will become very simple. When you are talking about salary income, the person, the assessee who is going to be covered in this chapter is the employee. So understand everything from the perspective of the employee. If there is any taxability, it is for the employee. If there is any exemption, it is for the employee. So you have to understand everything from the employee's perspective. There is a very significant amendment introduced by Finance Act 2020 relating to employers' contributions. There are two amendments actually. Both of them are related to employers' contribution. There has been some confusion amongst experts also as regards to how the amendment should work, how the amendment should be applicable. What should you do in the exams? What does the institute do? We'll discuss all of that in the course of this revision video. Chalo, let's begin with the content. Salary income is taxable for the employee either on due basis or on receipt basis, whichever happens earlier. So that means very simple. If your salary is due in previous year 2021, but let us say the amount, let us say in terms of amounts, the salary is due 7 lakhs, but the amount that is received in 2021 is 6,80,000, because the balance 20,000 is received in the next financial year 21-22, then due or receipt, whichever is earlier, implies that it will be 7 lakh rupees which will be taxable for the employee. Reverse situation, you may imagine an example where for previous year 2021 the amount due is 7 lakhs, but let us say the amount received is 7 lakh plus 35,000. What is 35,000? Salary of the next year received in advance. So it is going to be due in the next year, but you've received it in the current year, and that means it is this 735 which will be taxable in the current year. Of course, the 35,000 next year will not be subject to tax because you've already taxed it in 2021 on receipt basis. Whatever happens earlier, either due or receipt, whichever event happens earlier, that is the basis, that is the manner in which salary income will be taxable. Some common sense points to understand, they are nothing great. If you say salary is being received as a partner, then just because the word used is salary does not mean it will be covered under this chapter. For an income to be taxed under the head salary, there must be an employer-employee relationship that exists between the payer and the receiver. So when a partnership firm is paying salary to the partner, there is no employer-employee relationship. That income is taxable as PGBP. A partner is doing business and withdrawing his profits partly in the form of salary. So although the word used is salary, it will be taxed under PGBP. If you are an agent and as an agent you are receiving income, then you are not an employee. If there is a principal agent relationship, this agency income, commission income, will be either taxed as PGBP or taxed as income from other sources. That depends on the agent, and if he is doing agency activity on a regular basis, it is PGBP, or it will be taxed as IFOS. But if you are an agent, you are not an employee of someone, so salary as a head of income will not apply. If you are a director in a company, then there are two possibilities. You can be a director who is an employee, or you can be a director who is a non-employee. A non-employee director means a director who is participating in the business of the company, but only when there are board meetings. He does not participate regularly in the business affairs of the company, but he does take part in the management as a director. A non-employee receiving income from the company, taxable as income from other sources, or can be taxable as PGBP. If you are an individual who is a director in multiple companies, you are acting as a professional, you are giving services in a professional capacity, then it is PGBP, else it will be income from other sources. But somebody like a managing director, somebody like a whole-time director, a full-time director, who is an employee of the company, who will take decisions for the company, participate in the day-to-day management of the company, that person is definitely an employee of the company. The package given to that director is to be treated as income from salary. Sorry. One more thing that needs to be remembered. Many a times a question gives you information about salary received. The question will say basic salary received 14,000 per month, and the bracket will say TDS 2,000 per month, which means after deducting tax he is getting a check of 14,000 rupees every month. So his salary is not 14,000. His salary is 14 plus 2, 16,000. What will be that 2,000 rupees? Employer will deduct that amount and pay it to the government in the name of employee. When the employee will file his return of income, he will say this much tax is already deposited in my name. That means the amount of salary that he has received is 14,000. But we will have to add back this amount because salary received is different, salary income is different. His income is 16,000, he is receiving a check of 14,000 because of TDS. So if the information given is the amount received, then you add back the TDS amount to the received amount, and that is your salary income. Where does salary accrue? So generally speaking, salary accrues at the place where services are rendered. You work in India, salary accrues in India. You work outside India, salary accrues outside India. This is the general rule. But if you are a citizen of India who is receiving salary from the government, then even if the services are rendered outside India, this is covered by section number 9. And if you remember our revision videos, section 9 is income deemed to accrue or arise in India. So specifically this situation should arise. Specifically speaking, it should be this situation which should arise, that salary should be paid by Government of India to a citizen of India for services rendered outside India. And if this is the situation arising, then even if you are working outside India, salary will be deemed to accrue in India and therefore taxable in India. It's not the great concept, just one of the small topics to discuss. I just mentioned it. General rule, the place where you give services, that is the place where your salary is accrued. Now, how do you study this chapter? See, you will get practical questions. You will hardly get anything as theory from this chapter. And your chapter can be divided into these 5 categories. There are certain salary incomes which are fully taxable for all employees. Fully taxable for all employees meaning whether you are a government employee or you are a private sector employee, these incomes are fully subject to tax. There is no exemption allowed under section 10. So if these type of incomes are there in your question, all that you have to do is to calculate the yearly amount and say this is taxable. Suppose the amount is given to you on a per month basis, per month multiplied by number of months that he has done the job. Generally the question will give you information that he is working for 12 months. But it could be possible that the employee has joined during the year, so it will not be always multiplied by 12. He could have left the job during the year. So then you have to calculate his exact number of months for which he was doing the job. Take the income per month multiplied by the number of months. This is the amount taxable. This is something very simple. You will have many such adjustments in a salary question. You will see that these are incomes which are subject to tax. That's it, matter over. Basic salary, dearness allowance. Dearness allowance gets divided into 2 parts. DA in terms, DA not in terms. But in terms, not in terms, both these dearness allowances are fully subject to tax. Question will tell you 10,000 per month, 60% is in terms, 40% is not in terms. That means out of 10,000, 6,000 in terms, 4,000 not in terms, but both are taxable. Commission given on a fixed lump sum basis, commission given on the basis of the turnover, sales of the employer or profit of the employer, advance salary, arrears of salary, past years, past period salary becoming due now. So it was never due earlier. It was never taxed earlier. It is becoming due now. Salary is taxable on due basis or receipt basis, whichever is earlier. But arrears amount was never due earlier. It became due today, but it pertains to a past period. Fine, became due today, became taxable today. Bonus is an amount which is taxed only on receipt basis. Only on receipt basis. This is one small exception. Bonus is never taxed on due basis. Bonus is always going to be taxed on receipt basis. Certain allowances like tiffin allowance, medical allowance, servant allowance, city compensatory allowance, these are allowances, fixed amounts, but they are fully subject to tax. Amount received from keyman insurance policy by the employee, fully subject to tax. Basically, these incomes are fully taxable. I do not have to do anything other than pick up a calculator, find the amount taxable for the year and write it in my answer. That's it. Simple. These are salary incomes which are fully taxable. Then the chapter can be divided into 3 parts. Allowances, retirement benefits, perquisites. At the start of the video I said that this is a formula based chapter. These are the 3 places where you have formulas: allowances, retirement benefits and perquisites. You have to remember the formulas, and this way if you think, you can segregate all the formulas into 3 broad categories: allowances, retirement benefits, perquisites. And then there is this small thing of deductions that you get from the computation of salary income. Deductions part is also quite simple. A student has to actually make an effort in serial number 3, 4 and 5. 3, 4 and 5 where you have to basically just figure out what are the amounts of exemption, what is the exemption, what is the formula given. Deductions, straightforward, nothing great. Allowances, retirement benefits, perquisites, that is what you need to pay attention to properly. Chalo. First of all, let us finish off. First thing, salary incomes fully taxable. This is just a list given. These are fully taxable. If you have them in the sum, you have to just say they are fully subject to tax. Fine. Then we are talking about deductions. Now let us try and understand, first of all, what do I mean by these deductions? Now, what do I mean by deductions? So when you will prepare a solution for your salary chapter, if you have a question, your solution is going to look something like this. Broadly speaking, you will require 2 columns for amounts. There will be certain salary incomes which we just discussed, fully taxable. Then there will be allowances, retirement benefits, perquisites, and after all of this, what you will get as your answer is going to be called as gross salary. This will be your amount of gross salary. Like a businessman in his PGBP calculation gets some deductions, like you have deductions in the chapter of house property. In the chapter of salaries, you have 3 deductions. After you subtract these deductions, what balance remains? This is the taxable amount. This is the net salary. This is the net salary which is taxable. In technical terms, I would say that it is this amount which you will include. The net amount is what you will include in the computation of gross total income, the net salary after deductions. Deductions are only 3 and they are very easy to remember and easy to understand also. 16(1)(a), a standard deduction. Whatever is the amount of your gross salary. Gross salary का मतलब ये वाला figure. This figure is your gross salary. Gross salary or a maximum 50,000. Remember, 50,000 is not a monthly amount, it is the yearly amount. But then please do not say divide by 12 months. Whether the employee has worked for 6 months in a year or all 12 months, the deduction is a fixed 50,000. It is not a per month amount, but it is a 50,000 rupees maximum. Fixed nahi, that is also a wrong way to say. Gross salary or maximum 50,000, whichever is less. This is a deduction which is available to every employee. Second deduction, entertainment allowance, 16, clause number 2. There is a set formula for entertainment allowance. 20% of basic salary, actual amount of entertainment allowance received, maximum 5,000. Out of the 3 amounts, whichever is less. So what we need to understand is that entertainment allowance will first be included in your gross salary. In the working of gross salary, you will include entertainment allowance. Then you will include entertainment allowance at the full amount. Then from the salary, gross salary, you will apply this formula and take a deduction. And the maximum deduction is going to be 5,000. That means entertainment allowance over and above 5,000 is going to automatically become taxable. But then this deduction is allowed only to government employees. This formula of deduction, this is only available to government employees. That means for a non-government employee, the amount will be fully taxable. So in terms of problem solving, entertainment allowance will first be included in gross salary for all the employees. Only government employees will get this deduction, that too maximum 5,000. Non-government employees, you don't have to apply the formula. Automatically it means your entertainment allowance will become taxable. And the last deduction, 16 clause 3, this is called as professional tax, or it is also called as tax on employment. You may get one of these two wordings in your question. So if it is professional tax or tax on employment, this is something that is imposed by the Constitution of India. The amount should be paid during the year. If it is paid, only then deduction will be allowed. So if by chance the amount is still payable, if you have not paid let us say 2 months ka professional tax, then that amount will not be considered for your deduction. The amount actually paid to the government, only that will be allowed as a deduction. This is a tax that you have to pay to the state government. Amount actually paid will be allowed as a deduction. These are the 3 deductions, nothing beyond this. Standard deduction to all employees, entertainment allowance only to government employees, professional tax all employees. Professional tax, there is no amount put in the Income Tax Act as a maximum thing. Whatever is the amount of professional tax, you will get a deduction. Constitution of India has put a maximum limit of 2,500 rupees for the year. Income Tax Act does not put any amount limit. Whatever is the amount that has been paid, that will be allowed as a deduction. Standard deduction maximum 50,000 available to all employees. Entertainment allowance maximum 5,000 only available to government employees. So salary incomes fully taxable for all the employees, that is a list taxable for everyone. Deductions under section 16, 3 deductions. Now coming to the important part, the three things: allowances, retirement benefits, perquisites. At the last 1 week or last 10-15 days before your exams, I would not suggest or I would not recommend a student to remember section numbers. It would be great if you remember and write the correct section number in your solution. You will automatically score more marks. But at this juncture, when you are so close to the exams, don't put in efforts to just remember section numbers. If you naturally can remember something, wonderful. If not, no problem. Try and remember the formula correctly, so that when you solve, you are able to get the correct amount as exemption or correct amount as taxability. To the extent you can remember the section number, it's absolutely wonderful. Allowances. Now, first of all, what do I mean by an allowance? So, allowance means it is a fixed amount paid by the employer to the employee. Why is this fixed amount paid? This fixed amount can be paid for personal purposes. This fixed amount can be paid for official purposes. Purpose beyond a point of time is irrelevant actually. It is a fixed amount, meaning the thing to remember is allowance amount will not change. The amount of allowance will not change irrespective of the expenditure. Employee spends more, spends less, that is employee's lookout. Employer will give a fixed amount. Situation number 1, foreign allowance, section 10(7). Employer is Government of India, employee is citizen of India, services are rendered outside India. 1 minute. We just saw something like this earlier. If salary is paid by Government of India to citizen of India for services rendered outside India, salary is deemed to accrue or arise in India. This is as per section number 9. And if it is deemed to accrue or arise in India as per section 9, it should be taxable. Here we are studying section 10, which means we are studying an exemption year. So what is it? Is it exempt? Is it taxable? So the concept is very simple, beta. What is exempt is an allowance. Meaning, in this situation, say if all conditions are satisfied, if all the conditions mentioned above are satisfied, then I'll write two things. Any allowance that you receive, any allowance, it could be dearness allowance, it could be tiffin allowance, city compensatory allowance, house rent allowance, for that matter, any allowance that is paid to you. You're working outside India and the government is paying that allowance. Whatever be the name of the allowance, that allowance is fully exempt. But remember, only the allowance is exempt, huh? Only the allowance. Meaning something like basic salary, something like bonus, something like commission, something like profits in lieu of salary, they are not covered by section 10(7). Section 10(7) is only covering allowances. That means these amounts that we are talking about, they are taxable and they are taxable fully. Section 10(7) will give you an exemption only for allowance. It's not mentioned here in the notes. Because it's a topic that we are discussing the topic of allowance, but 10(7) covers allowance also and covers perquisites also. So allowance and perquisites fully exempt, but other salary incomes fully taxable because they are deemed to accrue in India. 10(7) is very simple. Condition 1, government should be paying the amount to you. Condition 2, you must be a citizen of India. Condition 3, services are rendered outside India. Very rare that you can have this thing in your question. If at all it comes up, it is one small adjustment, just a matter of remembering something. 10(13)(a), house rent allowance. Yes, this is something popular. This comes up in your questions also. House rent allowance, formula based, very simple. If the house rent, you are paying rent for the house, so the house that you have taken on rent, if this house is in Delhi, Chennai, Mumbai, Calcutta, in simple terms, if this house that you have taken on rent is in those 4 metro cities, then in the calculation of my exemption, the percentage to be selected is 50%. If the house is taken on rent at any other place, then I should be taking 40%. 50% or 40% of salary, first amount. Actual house rent allowance received by the employee, second amount. Rent paid minus 10% of salary, third amount. Out of the 3, whichever is less, this amount is your amount of exemption. So from the amount of house rent allowance received, subtract your exemption, balance remaining becomes taxable. The only thing to remember here is, see, 50% of salary, 40% of salary, rent paid minus 10% of salary. In this entire chapter, you will have the word salary mentioned at multiple places. And I'm pretty sure if you've studied the chapter earlier, by now you've understood this. Okay, salary means 3 things. Basic salary, dearness allowance in terms of employment, and commission only if it is as a percentage of turnover. All commissions are not covered. Only commission based on percentage of turnover is included in the meaning of the word salary. So in a question where you have house rent allowance, you will have to calculate the exemption. Step 1, before calculating the exemption, calculate this word salary. Take the basic salary, take DA in terms, take commission if it is on a percentage of turnover. Then take that total, that is salary, which will be used in point A 50%, 40%, which will be used in point C, rent paid minus 10% of salary. A, B or C, whichever is less, is going to be your exemption. Which brings me to my next point. Suppose my C amount becomes 0, or suppose my C amount becomes negative. Then what we will do is, we will make the exemption as 0. And we will say house rent allowance is fully taxable. एक second. How can point number C become 0? How can it become negative? If my rent paid is equal to 10% of salary, the answer will be 0. If my rent paid is less than 10% of salary, the answer will become negative. So Income Tax Act indirectly is trying to tell you that the house that you are taking on rent, for this house, your employer is giving you house rent allowance. For this house rent allowance, we are not going to make it fully taxable for you. We will give you an exemption. But employee, remember, if you pay rent which is lower than 10% of your salary or which is equal to 10% of your salary, you will not get any exemption. The entire house rent allowance received will be fully subject to tax. Exemption will be available to the employee only if the rent paid is more than 10% of salary. If the rent paid is less than or equal to 10% of salary, no exemption shall be allowed. Suppose the employee stays in his own house but is still receiving house rent allowance, or he stays in a house for which he does not pay rent. Say I am the employee doing a job somewhere, but I stay in my dad's house, so I'm not paying any rent to him. But my employer, my boss, is giving me house rent allowance. So in the formula, point C, rent paid will be 0. If rent paid is 0, exemption will be 0. Automatically, the entire house rent allowance received will be taxable. So two small things to remember in this section. Number one, remember the formula. 50% in case of 4 metro cities, any other place 40% of salary, actual house rent allowance received, rent paid minus 10% of salary. Least of the 3 is exempt. First thing to remember. Second thing, salary means you have to take 3 things: basic, dearness allowance in terms of employment, and percentage commission on turnover. Only these 3 items are to be added into the word salary. This is your house rent allowance. Exemption is available for house rent allowance. Exemption is available for foreign allowance. And third and the last exemption is 1014, special allowances. Now 1014 gets divided into 2 parts, clause 1, clause 2. Clause 1 are all allowances given for official purposes, whereas clause 2 is a list of allowances given for personal purposes. If the allowance is for official purpose, then check the amount received, compare it with the expenditure incurred by the employee. Out of the 2, whichever is less, this is the amount of exemption. So if you have spent, as an employee, if you have spent the allowance, then the amount spent will be given to you as exempt. If you have spent more, then the allowance will be fully exempt. If you spent less than the allowance, something will become taxable. Clause 1 is talking about those allowances which are on the basis of expenditure. So they are official in nature and you will get a tax benefit, you will get a tax exemption only if you spend the money. But clause 2 is an allowance given for personal purpose. Now exemption does not depend on expenditure. Your expenditure information has to be ignored. You have to rather remember the amount given by Rule 2BB. Rule 2BB of Income Tax Rules 1962 gives you a certain amount for a particular allowance. Employer can give you any amount of allowance. This will be the actual allowance amount. Compare this with the Rule 2BB amount. And out of the two, whichever is lower, this will be your exempt. This will be your exemption. So in terms of a question, your presentation will look something like this. Special allowance, so you will say name of the allowance, you will write the allowance, whatever is the name, that will be in the inner column, minus exemption under section 10 clause 14, subclause number 1 or subclause number 2. 1 if it is official, 2 if it is personal. Subtract the exemption. After this, if something remains, it is this amount which will be taxable. Now, list of allowances under 10.14.1. These are 6 allowances which are all given for official purposes. Just have to remember the names. Tour allowance, travel allowance, transfer allowance, daily allowance, conveyance, helper, research, uniform. Remember this. If in the question any one of these allowances appear, you must automatically understand this is expenditure based exemption. So now try and find out in the question, are you given the amount of expenditure? You will definitely be given the amount of allowance. The amount of allowance, that information will be given to you in the sum. You will have to now figure out how much is the expenditure incurred by the employee. If the information is given, take that information, compare the allowance and the expenditure, whichever is less is your exemption. Many questions of the institute, you will find that no information is given to you about the expenditure. You need that data. You need it to calculate your exemption. Exemption depends on expenditure. You need it, but that information is not given only. So two simple assumptions that a student can make, and you are free to assume anything of the two. Number one, you assume that the entire amount is spent. Expenditure incurred is equal to allowance, which means fully exempt, zero taxable. Other extreme assumption, zero spending, nothing is incurred. The allowance is received from the employer and the employee is not spending anything. Then the amount is fully taxable for the employee. If the information is given, you will not have this problem. But if the information is missing, you will have to make any one of these two assumptions. These are the two most common assumptions. So you are free to do any one of them. Either assume fully spent, to exempt, or assume nothing spent, to fully taxable. 10.14 subclause number 2. This is the list of personal allowances. You will have to make an effort in remembering the Rule 2BB amount. This is an entire list. Just go through the list. It is nothing great. Important ones to remember which repetitively come up in your exams. Transport allowance comes up in your exam frequently. Children education, children hostel expenditure allowance, underground allowance, monthly allowance for personal expenses of employee. All the other allowances that are there, give it a reading once. You can get a theory question. Although to be very frank, last 7 to 8 attempts, there hasn't been a theory question based on special compensatory allowance. There has been no theory question. Salary by itself is such a huge chapter that the examiner is going to 99.9% ask you a practical sum only. He is not going to ask you anything theory. Just to play safe, just to not leave out anything, I am asking you to read this. You will get if you get a question, you will get a theory question. You just have to remember that if it is a special compensatory allowance, the employee is working in some special areas. I don't know if you know the meaning of the term. the employee is working in some special areas. Special areas mean border area, high altitude area, snowbound area, difficult area, disturbed area. He's working in some special areas. He's not working in a normal city type area. So in the form of a compensation, employer is giving an allowance. Employer is giving a fixed amount in the form of a compensation. Income Tax Act is giving you the amount of exemption. Remember that this column that you have, the right column, they are not the allowance amounts. They are the amounts as per rule 2BB. Your actual allowance could be equal to this, could be less than this, could be more than this. That depends on the employer giving the money to the employee. For example, serial number 3, children education allowance. Children education allowance. Maximum 100 rupees per month per child. This is the exemption amount. You may get an allowance of 60 rupees. You may get an allowance of 600 rupees. The exemption is 100 rupees per month. The actual amount can be anything. So just have a simple reading of this. To the extent you can remember the amounts, remember them. It's not a difficult table. You can easily remember it. You will just require 1 or 2 readings. In a classroom environment, I generally give some time to the student to read, and then I ask things on a random basis. Even you can do the same thing. Read the table for about 2 or 3 times, and then on a random basis test yourself. You will easily remember the amounts. This is your 1014, and this is the last of the exemptions. That means if I have to, summarize the exemptions, I would say something like this, that allowances that you get can be either covered by 10(7) or covered by 10(13)(a) or covered by 10(14) subclause number 1, subclause number 2. If this happens, then my presentation will be like very simple. I will say whatever is the allowance received minus the exemption as per the section, whichever section gives me the exemption, balance amount is taxable. But then if by chance my allowance amount is not covered in any of these 3 sections, then the allowance amount is fully taxable. Then there is no exemption allowed. I can probably draw a third branch of this chart and say that if the allowance is an entertainment allowance, then there is no exemption available as such. There is no section 10. It is not an exemption. It is a deduction under section 16. So I can say entertainment allowance, government employee, deduction is available under section 16. But in case of other employees, entertainment allowance will become fully taxable. It's an allowance, so I'm mentioning it. But then allowance is probably the simplest part of the chapter. 10(7) for an allowance, there is nothing. The allowance amount is fully exempt if those 3 conditions are satisfied. 10(13)(a) house rent allowance, yes, there is a formula in that. A formula based question can come up. Remember the formula. 10(14) subclause number 1 official allowances, remember the names. Subclause number 2 personal allowances, remember the name and the amount. In the question, if you get any allowance which does not fall in 10(7), 10(13)(a), 10(14), then it is becoming fully taxable. This is your first part of the chapter, allowances. Now going ahead, retirement benefits. This is a full formula based concept. Many retirement benefits, important ones, gratuity is important, provident fund is important. In fact, first 4 will be important: gratuity, pension, leave salary, provident fund. One thing at a time. As I said, it's formula based. You just have to remember small nuances, small things. So that is where a student has to take care. Gratuity. Government employee enjoys 100% exemption. No formula, fully exempt. So if the question says you are a government employee who has retired during the year and received gratuity, amount, whatever be the amount, fully exempt from tax. If you are not a government employee, then you could be an employee covered by the Payment of Gratuity Act. Payment of Gratuity Act is applicable only to certain selected organizations. And if you are covered by Payment of Gratuity Act, your exemption formula is slightly different. Maximum limit of 20 lakh rupees. Of course, in the exemption formula, actual amount will always be included. If you remember the house rent allowance HRA formula, actual HRA was part of my formula. Entertainment allowance, it's not an exemption, it's a deduction. But if you go to that formula, it says actual allowance received is one out of the 3 items. So whenever you have this concept of whichever is less, one of the 3 things, one of the 4 things is going to be the actual amount. First point is actually something important. 15 by 26 into last salary drawn into completed years of service. Last salary drawn, which means the last month salary. The last month's salary, the salary that I am withdrawing when I am retiring. 15 by 26. 26 are the working days in a month, excluding the Sundays. 15 days out of 26. It is not half. 15 by 26 is not half. 13 by 26 would be half. 15 by 26 is something more than half. So 15 by 26 into last month ka salary. So take the last month ka salary, divide by 26, multiply by 15, multiplied by completed years of service. If your completed years of service is fraction, 27 years and 10 months, then it will be rounded off to 28 years. But the fraction should be greater than 6 months, which means if it is 27 years and 6 months, if it is 27 years and 3 months, then the rounding off will not happen. For your calculation, you will take 27 years only. So first amount is this mathematical thing, 15 by 26 into last salary drawn into completed years of service. To tell you the truth, it's not a mathematical thing. This 15 by 26, I'm sure many of you might be knowing this. This 15 by 26 point number 1 is actually the formula used in Payment of Gratuity Act. My employee is covered by Payment of Gratuity Act. Income Tax Act has just adopted that formula and put it up in the exemption. So point 1, 15 by 26 into last salary drawn into completed years of service. Actual amount, maximum 20 lakhs, whichever is less. So in terms of exam presentation, in a question, what will you do? You will say gratuity received in the current year minus exemption under section 1010. Government employees, this will be fully exempt. Employees covered by Payment of Gratuity Act, this exemption will be as per the formula that we just studied. Balance remaining will become taxable. If my employee is not covered by Payment of Gratuity Act, then the exemption formula changes. Maximum 20 lakhs, definitely part of the formula, but it says maximum 20 lakhs over lifetime of the employee. Meaning this point number 3 will be over employee's lifetime, he will in all get an exemption of 20 lakhs. 20 lakhs minus previous exemptions claimed by the employee under section 1010. Previous, in his earlier jobs, he has claimed exemption under 1010. Then those exemption amounts will be reduced from this 20 lakhs. Points to remember, simple enough. When I say previous exemptions, these previous exemptions can be any. Employee could be covered by Payment of Gratuity Act. Employee could be any other employee. employee could be a government employee. So he's a POGA employee, he's a other employee, he's a government employee. Previously he could be any one of these three, and he has taken exemption under Income Tax Act 10 subsection 10. Then whatever exemption he has already taken will be reduced from this 20 lakhs. Today, point to observe, this concept is applicable for other employees only. So if you are an employee who is covered by the Payment of Gratuity Act, 20 lakhs will be, I don't know if you can make sense, a fresh limit available every time. If my employee keeps on changing his jobs, and if he keeps on working at a place where Payment of Gratuity Act applies, every time he will leave a job, he will get gratuity, he will calculate his exemption. 20 lakhs will be the fresh limit every time. But if when he is leaving a job, he is covered by the others category, the place where he is working, Payment of Gratuity Act does not apply, then take the maximum amount 20 lakhs. If at all by chance my employee in his life in the past has taken any exemption under Income Tax Act for this gratuity, subtract it from this 20 lakhs, and that will be the third amount. Second amount, actual gratuity received, it's always going to be part of the formula. First amount, half into average salary into completed years of service. In this case, fraction is to be ignored. Whether it is greater than 6 months or more than 6 months, it will be ignored. Half into average salary. What do I mean by average salary? Average salary means, take three things: basic, DA in terms, percentage, commission on turnover, but you have to take an average. So when you are taking an average, it means what will happen is you will take the total and you will divide it by 10 months. Average in this case is to be taken for 10 months. But total of which thing? Total of those three amounts: basic, DA in terms, percentage, commission on turnover. And these 10 months are to be counted preceding the month of retirement. This is the place where students make errors. I'll just take one example. I won't go into an in-depth discussion. Here what I have to do is, first of all, determine the month in which my employee has retired. If the month of retirement, let us say we are in the month of November. So if the month of retirement is November, then my 10 months are going to be January 2021 to October 2021. Now for these 10 months, I have to take basic salary, dearness allowance, percentage commission on turnover, take them as a total and divide by 10. If by chance my month of retirement is, let us say, the month of May, my employee retires in May 2021. So now working reverse, my 10 months will be, go calendar year wise, it will be very fast. 2021 calendar year, I am retiring in the month of May. Starting of May, middle of May, ending of May, does not matter. I am retiring in the month of May. So going reverse, April, that means 4 calendar months of 2021, and preceding calendar year 2020, 6 months, which means starting from August 2020 to April 2021. These are 10 months preceding the month of retirement. Now check, in these 10 months, what was his basic salary? Has it increased? What is his dearness allowance in terms? Has it increased? Has it remained constant? What is the percentage commission on turnover? Take the actual figures for these 10 months. Numerator divide by 10 months will give you average. That average is what you are going to use here. Half into average into completed years of service. Second amount actual gratuity. Third amount maximum 20 lakhs. Whichever is less is your exemption. Remember that this exemption is available only when you receive gratuity on retirement. Sir, what do you mean by this? If gratuity is received during service period, fully taxable. Now does not matter whether the employee that I am talking about is a POGA employee, is an employee not covered by Payment of Gratuity Act, is a government employee, but gratuity received during service period is fully taxable. No exemption is available at all. This was your gratuity discussion. Chalo, going ahead. See, pension now, you have to keep one thing in mind. Pension mein there is one small difference as compared to the other retirement benefits. In pension, what happens is that you first have to figure out the type of pension, and then you look at the type of employee. Gratuity, leave salary, what is also called as leave encashment, provident fund. You will observe that the formula is dependent on type of employee. First thing to observe is government, non-government, and then you decide the formula. Pension mein it is not like that. Pension mein first of all you decide nahi, matlab you observe what is the type of pension that the employee is getting. If the type of pension that he is getting is monthly pension, he gets pension on a per month basis. This is how normally everybody gets pension. This is fully taxable. It is like a revenue income. It is like a revenue income. Before doing the job, I was earning basic salary. After the job is over, now I have retired, I am getting monthly pension. Like basic salary was taxable fully, monthly pension is also fully taxable. Now that is applicable to all employees, government, private sector, monthly pension is fully taxable. What needs to be taken care of is silly mistakes that students do here. Question will give you monthly pension rupees 12,000, and out of our habit we say 12,000 multiplied by 12. The moment we see a per month amount, we multiply it by 12. Remember, pension is received after retirement. If my employee has already retired in a past year, my employee is already retired 2-3 years ago, then in the current year he is definitely going to receive pension for all 12 months. 12,000 multiplied by 12 is correct. But if the question says the employee retires in the current financial year 2021, then you cannot multiply it by 12, because pension income will begin only after retirement. So you find out the month in which the employee has retired. If he is retired in the month of June, monthly pension will begin from July. If he is retired in the month of November, monthly pension will begin from December. So accordingly, in the counting of number of months, you will have to take care about this aspect. This is something that I have mentioned in the remarks column. If he has retired during the year, take care in the calculation of number of months. If he has retired in an earlier year, then he will keep on getting monthly pension every month for all 12 months. Second type of pension is lump sum pension, where monthly pension is converted into a lump sum amount. That means once the employer pays the lump sum amount to the employee, he is no longer required to pay monthly pension any further. Instead of paying 12,000 rupees per month, it will be converted into a lump sum amount using a mathematical concept, using time value of money, using mortality tables. That's not part of the study of income tax, but all these things will happen practically. A lump sum amount will be given to the employee. After employer pays lump sum amount to the employee, he is no longer required to pay monthly pension. Now this lump sum benefit, here there is an exemption available. If you are a government employee, lump sum amount fully exempt. If you are a non-government employee, then you check at the time of retirement has my employee received gratuity, then the exemption component is 1/3. If at the time of retirement employee has not received gratuity, exemption component is half. So a simple way to understand, if you have received gratuity, now when do you receive gratuity? On retirement. So you have received gratuity, that's your retirement benefit, you received it. Then today your exemption is slightly less, 1/3, 33%. But at the time of retirement, if I did not receive gratuity, so I did not get one retirement benefit, then today the exemption benefit will be slightly more, half, 50%. So received gratuity 1/3, not received gratuity half. Of what? Of an amount called as TCV. TCV stands for total commuted value. If the total pension is converted into a lump sum amount and taken, that figure that you will get is a total commuted value. As an employee, when I am taking lump sum pension, it can be the entire pension converted into a lump sum amount, or it can be a part, a fraction, a certain component getting converted into lump sum. So if I convert 75% of my pension on a lump sum basis, then I will have to do a reverse working, that for 75%, if I am getting X rupees, what would be the amount that I get for 100%? That figure will be total commuted value. Total commuted value means the amount that I receive on commutation on lump sum divided by the percentage that is commuted. I took 75% in my example. If I convert 60%, then I will find proportionate 100%, and that figure will be total commuted value. And is total commuted value ka 1/3 or half will be the exemption. So my working will be, this is important, remember this, students make a mistake here also. The simple trick that I would say is received minus exempt taxable. This received can be the entire pension converted lump sum or a part amount converted lump sum. This exemption is calculated as 1/3 or half of total commuted value. Received minus exempt is the amount that is taxable. Just to mention one more thing here, because it comes up in papers quite frequently. If a complication has to be created about pension, then this type of a numeric example can be done, that the monthly pension is 12,000 rupees. The employee retired in the month of June 2020 and he took 60% pension lump sum, but he did not take 60% pension lump sum immediately. He took this 60% pension lump sum in the month of January 2021. So now when I do my calculations, I have to take care, number one, pension will not be there for 12 months, pension will start after retirement. My employee has retired in the month of June. So from July pension will begin. July 2020 to December 2020, he would get 12,000 rupees per month for 7 months. This will be 7 months. No, sorry, 6 months. So this will be 72,000. But then from January 2021 to March 2021, he has only converted 60% lump sum. So for those 3 months, 40% will still continue on a monthly basis. And so it will be 4,800 every month for 14,000. That means that will be 14,400. And this will be the monthly pension taxable. And as far as lump sum pension is concerned, I will say 60% is the X amount. So what is the proportionate 100%? That is TCV. If employee is a government employee, then I don't need to do this working of TCV. Then the amount received is fully exempt. If you are a non-government employee and received gratuity, TCV into 1/3. If you are a government employee, TCV into, if you have not received gratuity, TCV into half. If you have received gratuity, TCV into 1/3. तो ये तुम्हारा पेंशन का डिस्कशन. थर्ड बेनिफिट, लीव सैलरी, लीव एनकैशमेंट. This in simple terms means that leave is not taken by the employee. Leave is not taken by the employee. He has worked extra. So for working extra, you need to pay extra salary. Extra salary for the extra working. In a year, you don't have to work for 365 days. You will get a certain number of days as leave. If you do not take that many number of days as leave, it means for those days also you have given service to your employer, you have worked for your employer, so he will pay you extra. That is what is called as leave salary. If leave salary is received during service period, exemption not available, fully taxable. Exemption is available only if the leave salary is paid on retirement. Now when you receive the money on retirement, government employee, fully exempt. Other employees, the formula is now comprising of 4 things. Number 1, actual leave salary received, actual amount. Number 2, maximum 3 lakhs. But the concept of over lifetime of employee is applicable here. This was the same concept that we saw in gratuity others, other employees. Maximum over lifetime. There the limit was 20 lakhs, here the limit is 3 lakhs. We have a concept of average salary here. And average salary is basic, DA in terms, percentage commission on turnover for 10 months preceding the date of retirement. In gratuity, it was preceding the month of retirement. Instead of month, here it is date. But the formula still remains the same. Take the total of those 3 amounts divided by 10 months. This will give you average salary. Second point is 10 months into average salary. Average that you are calculating is after dividing 10 months. Point number 2, you are multiplying it by 10 months. So I don't know if you can understand, but second amount will be nothing but the numerator that you will get in your average formula. First point, balance of leave as per income tax multiplied by average salary. Just one thing that I'll clarify, which we'll use in 2 minutes. If you are taking average, that means you're taking total divided by 10 months. This average salary will be a monthly figure. Just remember this, it will be a monthly figure. Now we are talking about balance of leave as per income tax. What is this? This working. You will be allowed a certain number of days as leave every year. Your employer will give you maybe, let us say, 45 days in a year, 60 days in a year, 1.5 months in a year, 2 months in a year, 75 days. It could be anything. Income tax says maximum 30 days for every year that you work. This is for the exemption purposes. So select the number of days, consider the number of days allowed by employer, number of days for which you can take a leave, compare it with maximum 30 days. Whichever is lower is the number of days per year, multiplied by completed years of service. Number of years, fraction to be ignored. 6 months, more than 6 months, less than 6 months, forget it. Take the number of years for which you have given the service. So every year you are entitled to take X, every year you can take X number of days as leave. What is X? 30 days or amount allowed by employer, whichever is less. You have worked for Y number of years. So X into Y is your total number of days. In the entire service period, you can take these many number of days as leave. You have taken something less. Whatever actually you have taken, you subtract it. Leave amount actually availed by the employee. You are entitled to take X into Y. You've taken Z. So the difference X into Y minus Z is the leave balance. Balance leave for which you are actually getting the payment. This is the working done as per income tax. And this figure, balance of leave as per income tax, this is what we are going to consider in our exemption formula. Now got to understand one thing, very common sense thing. It is possible that my balance of leave as per income tax will be certain number of days, but we are multiplying it by average salary. So average salary is a monthly amount. So what I should do is, ideally I can't straight away multiply monthly amount into number of days. So I get this number of days, I divide this by 30 days. So this will give me proportionate number of months. And then I multiply it by the average salary, which is a monthly figure, and this will be the first amount. This is the first amount which I'm going to use in my exemption formula. Leave encashment, leave salary, this is something very simple, very straightforward, nothing great. All that you have to do is, as I've said, you have to remember the formula. Provident funds. Now, 4 type of provident funds: statutory, public provident fund, recognized provident fund, unrecognized provident fund. Public provident fund is a provident fund where there is no employer making any contribution. Anybody from the public can open an account in the PPF. Statutory provident fund, which means we are talking about a government employee. Recognized provident fund means it is recognized by the Commissioner of Income Tax. So it is a recognized fund as per income tax law. But obviously it means unrecognized fund means it is an unapproved fund. The Commissioner has not given his approval. It is unrecognized, it is unapproved. Statutory provident fund. Now, provident fund, the discussion can be divided into 2 parts. What happens every year during service period, and then what happens when you receive the money on retirement. So statutory provident fund, employer makes a contribution every year, exempt for the employee. Interest credited every year, exempt for the employee. If the employee himself makes a contribution, he will get a deduction under section 80C from gross total income. And when he will receive the lump sum money from statutory provident fund, that will be fully exempt. So statutory provident fund, government employees, they are going to enjoy tax exemptions. Lump sum amount received will be exempt. During service period, contributions will be exempt. And as an employee, if I make a contribution myself, I will get a tax deduction under 80C. In case of public provident fund, as I said, there is no employer involved. So employer does not contribute. I make a contribution myself, I will get a deduction under 80C. Interest credited to the fund, exempt. And lump sum payment received from PPF is also fully exempt. So I will make a contribution myself, I will get a deduction under 80C. Interest accumulated every year exempt. Lump sum money withdrawn, exempt. Unrecognized provident fund, I'll take up that first. A fund which is not granted approval, a fund which is not granted any recognition in the eyes of Income Tax Act. During service period, employer's contribution is exempt during service period because tax will be imposed at the time of retirement at the end on the employee. So every year employer contributes, exempt. Every year interest credited, exempt. As an employee, when I am making a contribution, my fund is unapproved, unrecognized. So there is no deduction allowed under section 80C or under any other provision of the Act. There will be no deduction at all available. When I receive the lump sum amount, it will comprise of these four things. Lump sum amount will include employee's own contribution. It is employee's account and he is receiving his own contribution back. This is like principal amount. This is like making a fixed deposit and getting back your principal amount. That is not taxable. That's not my income. That is my own money being paid back to me. Employer made a contribution during service period. During service period it was exempt. Now it's going to be taxable as salaries. Interest that was accrued every year, if the interest is on employer's contribution, then it is taxable as salary. But if the interest is on employee's contribution, then it is taxable as income from other sources. So lump sum amount will be taxable. My own contribution is exempt. It's like my principal amount. Employer's contribution, lump sum received by me on retirement, taxable. On that employer's contribution, interest, taxable. And interest on my own contribution, employee's contribution, is taxable as IFOS. The interest will be always at a particular rate and the rate will be constant. So if in the question you are given total interest amount, then how will you split it? You will split it in the ratio of total employee's contribution and total employer's contribution. In that ratio you will split it, and interest on the employee's contribution, IFOS. Interest on the employer's contribution is salaries. Now talking about RPF, Recognized Provident Fund. Before I start talking anything, I would like you to read something which is coming up on the screen. Section 7. Incomes deemed to be received. In one of the past videos you will observe I have mentioned something about section 7 and I had told that it is ineffective now because of the Salaries amendment. Why did I say like this? What is the provision? Employer makes a contribution to Recognized Provident Fund. That's what we are about to study. If it is greater than 12% of salary, then the extra amount becomes taxable. This is the old provision. This has not been deleted. This has not been deleted. But a new concept is introduced. This is the amendment that I was referring to. You have to take, no, this might be the wrong place. I have some space. Yeah, lucky. Employer contribution to Recognized Provident Fund. To Recognized Provident Fund minus exempt 12% of salary, balance amount was taxable. This was the old provision. Second thing in the old provision was employer makes a contribution to Superannuation Fund. We used to get an exemption of 1,50,000, only the balance was taxable. And third, if employer makes a contribution to a pension scheme that is referred to in section 80 CCD, National Pension Scheme, then this amount used to be fully taxable, fully. This was the old provision. Now what did the government do? Government introduced a new provision. This was section 17 subsection 2 clause number 7. This was as per section number 7, and employer's contribution was fully taxable. Now the new amendment was section 17(2) clause 7 was redrafted. In the redrafting, it said employer contribution to RPF plus employer contribution to superannuation fund plus employer contribution to pension scheme. Take the total, and from this total you delete 7 lakh, you give an exemption of 7,50,000, and the balance will be taxable as a perquisite. This is the amendment. So first thing that every student can easily figure out, if 17(2)(7) has been redrafted, that means the old 17(2)(7) is gone, and that means the limit of 1,50,000 is gone. But now the problem arises is that section 7 is still there in the Income Tax Act. So now the confusion arises. Look at the screen please. When I take employer's contribution to RPF, should I take it after applying section 7, or should I take it ignoring section 7? Both the point of views, there were multiple chartered accountants who said section 7 is still there, you should take exemption of section 7 also, and then take this exemption of 7,50,000 also. Whereas certain chartered accountants were of the opinion that because of the amendment, section 7 is old, and so you should not do 12% of salary, you should take the full employer's contribution to RPF and cover it under 7,50,000. This is the practical aspect. Now comes a very ridiculous thing actually. What is the institute doing? If you open the study material of institute has printed this new section in the theory part, but in every practice question that the institute has in its study material, it has not given effect to 7,50,000. It has given effect to section number 7 only. The last time I saw the study material, this was the situation. After that, if the institute has updated it, amended it, so then it is really good on the part of institute to do it. But ICAI has not made any change in the practical sums, but has made change in the theory. So still institute is giving effect to section 7 in practical sums, but in the theory is mentioning the amendment. Now interestingly, in the statutory update that institute releases for CA inter students, you will find it on the website. They have solved a numeric example based on another amendment. After clause number 7, there is a 7a. When I do the perquisite discussion, I'll do that with you. They have printed the amendment in the statutory update, and then they have explained the amendment in the numeric example. And in that numeric example, what the institute has done is that it has ignored section 7. What the institute has done is section 7 has been completely ignored. That means even this 12% of salary is deleted. That means employer's contribution to RPF, superannuation fund, pension scheme, all of this should be taken as the gross amounts. without subtracting any exemption of 12% of salary, without subtracting anything as 1,50,000, you take the total amount given in the question. Take the total of these three and then take a lump sum blanket type exemption of 7,50,000. Balance amount is taxable. This is what the institute has done in its statutory update. Some CA final faculties also follow this aspect. This thing that is mentioned, that they do everything as per gross amounts. They ignore section 7. Section 7 no longer applicable. Old 17 subsection 2 clause number 7 no longer applicable. 80 CCD pension scheme fully taxable. Even this will now be no longer fully taxable. You will get an exemption. So the old thing is completely deleted. I would suggest in your exams you do this, because although the institute in its study material has not given effect, but in the statutory update it has included the amendment and taken the full amount without any 12% of salary exemption, taken the full amount. You'll find the statutory update on the website. You can go ahead and check it. Some CA final faculties do not mention anything about the amendment. In the study material, they just print the theory part. They don't take a numeric example. They don't explain anything in lectures. Some CA final faculties do take this point of view, and institute indirectly is taking this point of view. So in the question, in your exams, employer contribution to RPF, Superannuation Fund, pension scheme, take the full amounts printed in the sum, take a total of those three, minus 7,50,000, balance amount is taxable as a perquisite. This means this will be taxable as a perquisite during the service period. During the service period. So this is, we were doing RPF discussion. This is how it's going to go for employer's contribution. Employee himself makes a contribution, he will get a deduction under 80C. Interest will be computed in the prescribed manner. This is the second amendment that I was referring to. This is section 17 subsection 2 clause number 7A, newly inserted, and there is a detailed formula for this. When I do the perquisite discussion with you, at that point of time I will discuss this formula with you. So interest will be taxable, but there is a complicated formula for this. What happens when you get lump sum amount from RPF? RPF lump sum amount. If you have worked for 5 years or more, lump sum amount is fully exempt from tax, no questions asked. Whatever amount you are getting, fully exempt. If your service period is less than 5 years, but you are still leaving the job, why? Because of your own ill health, because the employer had to shut down his business, or because there was any reason beyond the control of employee. Now you can't do anything. You joined the job, you worked for 3.5 years, suddenly you became so ill that you had to quit the job. Suddenly your employer shut down the business and shifted outside India. You can't have any control over this. Then the exemption will be allowed to you. Lump sum amount will be fully exempt even if a service period is below 5 years. If the service period is less than 5 years and you have changed your job, and instead of taking the RPF money in your bank account, you have transferred the money into new RPF account. Say you were doing a job with Tata Consultancy Services, TCS. They have a RPF. Now you shifted from TCS to Wipro. So the RPF account maintained with TCS, option 1, you can take the money in your bank account. If you do that, it will become taxable. So what do? You tell TCS, transfer this RPF money into Wipro's RPF. The RPF maintained by Wipro, you will transfer the money from one RPF account to another RPF account. So the money is still revolving in an RPF account only. Then you will get an exemption. Lump sum amount will be fully exempt. No tax will be charged from you when you transfer the money from one RPF account to another RPF account. But if your service period is less than 5 years and you don't fall in the above two situations, now the amount will be taxable. So if it's 5 years or more, fully exempt. Less than 5 years, but ill health, discontinuance of employer's business, Any other reason beyond the control, transfer from one RPF account to another RPF account, exemption allowed. All other cases, money received is taxable. This is your Provident Fund discussion. A very small section, voluntary retirement, with hardly any chances for this to come up in your exams. I'll just spend 2 minutes on it. It's a formula based thing. The question will indicate to you that the employee has taken voluntary retirement. It will tell you that on voluntary retirement, so and so amount is received. Your exemption will be, take the last salary drawn by the employee. What does the word salary mean? The same 3 standard things: basic salary, dearness allowance in terms of employment, percentage commission on turnover. Take the salary of the last month when you are retiring, multiply by 3, multiply by completed years of service. This time when you are talking about completed years of service, all the fractions will be ignored. Salary into balance months to superannuation. Superannuation means automatic retirement, but we are visualizing a situation of voluntary retirement. So we will now figure out, if today I am retiring voluntarily and the age of automatic retirement is, let's say, 60 years, and today I am retiring at the age of 50, I have 10 more years. If I don't take voluntary retirement, I have 10 more years. 10 years meaning 10 years into 12, 120 months. Those are the balance months to reach the superannuation. Take the last salary drawn, multiply by 120 months. Select the higher of the two, first amount or second amount, whichever is higher. Then compare it with the actual compensation and maximum of 5 lakhs. Now 0.3, 0.4 or 0.5, whichever is lower, 3, 4, 5, whichever is lower will be the amount of exemption. Subtract the exemption, balance remaining is going to be taxable. Formula based, but probability is very less that you get anything in the sum in the paper. Just remember the formula. If I would say, if you are unlucky and a small adjustment comes up, should not be stuck up with it, should not just bluff anything. There is a formula, just remember the formula. Last retirement benefit, amount, lump sum amount that you receive from superannuation fund. So what fund is it? It is a superannuation fund. So you are going to receive the money at the time of retirement. But which retirement? Automatic retirement. Just 2 minutes ago I took the example. Okay, if my age is 60 years, that means automatically I will retire at the age of 60 years. The moment I become 60 years old, that is the last year of my job, I will retire. That is called as superannuation. Now we have a fund from where I will get money on superannuation. So if I receive money on superannuation, fund was created for superannuation purposes and I am receiving the money on superannuation, lump sum received, fully exempt, monthly received, fully taxable. So there is a accumulated lump sum balance in the fund. If I decide to withdraw it on a per month basis, it is identical to monthly pension. So like monthly pension was fully taxable, this is also fully taxable. But if I withdraw lump sum amount in one shot, then the amount is fully exempt. When am I withdrawing the amount? On superannuation. Or the second situation visualized is disability. I have to quit the job because of my disability. So lump sum amount is exempt. If amount is received on death, but obviously it will be received by the legal heirs. So for the legal heir, the amount received is fully exempted from tax. We will not collect any income tax from the legal heir. If you are transferring the money from the superannuation fund to the national pension scheme, then exemption is given. This is a tax incentive to promote national pension scheme amongst the people in India. You have a superannuation fund. If you transfer the money into national pension scheme and don't take it in your bank account, transfer the money into national pension scheme, then you will get exemption. Common sense, understand this. If you receive the amount on superannuation, then to anyways it is exempt. If you withdraw the lump sum money on superannuation, it is exempt. Don't transfer it into a pension scheme account. I can withdraw the money, take it in my bank account and claim exemption. So point number 3 is going to be beneficial or is going to be used if amount is received before superannuation. What is the name of the fund? The name of the fund is superannuation fund. If you receive the money on superannuation, you will get exemption. But what if you are quitting the job before it? Example, voluntary retirement. What if you are quitting the job before it? Now if you take the money in your bank account, it will become fully taxable for you. So ek kaam karo, open a pension scheme account. If you already have an account, no problem. Otherwise, open a new account and from the superannuation fund, transfer the money into the pension scheme. Then you will get exemption. Any other case, lump sum amount will be fully taxable. That means any other case, meaning this is where the employee has received the money. Actually, instead of transferring the money into some pension scheme account, he has actually received the money and it is not on superannuation. Now the amount will be taxable. Nothing great here, easy to remember. Important things in retirement benefits, I would say gratuity, formula based, pension, leave salary, provident funds. And provident funds during service period there are amendments. There is this new clause number 7 inserted. This brings us to the end of retirement benefits. So if you understand what all things we have done, now salary incomes fully taxable discussed, deductions discussed, allowances discussed, retirement benefits discussed. The only thing pending will be perquisites. So in a second video, I will discuss everything relating to perquisites. Perquisites is something lengthy. So this video, I'll restrict myself to these 4 items. Perquisites, I will upload the video probably tonight or tomorrow morning, definitely. So this is something, this is the pending part. Everything else, salaries chapter can be revised from this video. In the description of this video, you will get the Google Drive link like in every other videos you have. You can download this entire PDF in the from that link. This PDF of salaries chapter, it's a PDF of about 24 sides. 24 sides ka PDF. You can very safely use this PDF for your last day revision. In fact, I don't know whether I have mentioned it in my earlier videos. Every PDF that I am putting up along with the videos can be used for your last day revision. I am summarizing the entire chapter and making it so concise that everything that is necessary for examination is included in the PDF. So the chapter like salary, which is so lengthy, can be just quickly revised using these 24 sites. So download this PDF from the link. Look at the video. You have any doubts, you can post it in the comment section. Chalo. That's it for this video. Perquisites remaining pending. That will be part 2. I'll put it up very shortly on the channel. Chalo. See you guys. Goodbye. Happy studying.